On October 2nd, I highlighted Insulet and Dexcom as top picks with average analyst targets for a 60% plus return. Those two stocks are now up more than 28% in the past month as the hype around weight loss drugs breakthrough is busted, and I found 5 stocks with further to run. Hey Bowtie Nation, Joseph Hogue here with one of my favorite investing strategies, playing contrarian against Wall Street hype. The market loves to latch onto a story, blow it up, and make you think it's going to revolutionize the world. Related stocks soar while others plunge on fears of obsolescence, and investors rush in only to realize that they're the last ones to the party before the punch bowl gets taken away. The latest crazes around weight loss drugs, those GLP-1s like Wegovy and Ozempic, and that hype cycle is starting to fade. I'm going to reveal why and the 5 stocks primed to rebound. Don't forget to join the community by tapping that subscribe button so you don't miss a single episode. And don't miss next Wednesday's video where I'll show you how to create weekly cash flow with just 12 stocks. It's why I created this quick 3-step guide to making your investing plan. Within 5 minutes, you'll be able to create an investing plan that makes your goals the motivation to keep investing and that is customized to your needs. I'll leave a link in the description below. It's totally free, just something I wanted to do for all you out there in the community. So click through, get your step-by-step guide now. Nation, I've seen too many investors miss out on the opportunity to make their money work for them, and it's all because they didn't have a plan that fit their needs. So look for that link and get your free customized plan. Back to those rebound stocks though, because this year the hot story has been all around the breakthrough in weight loss drugs like Wegovy and Ozempic. Test patients have been able to drop 10 pounds plus on these drugs, and sales have jumped. Shares of drug makers like Novo Nordisk, ticker NVO, are up 78% this year, and Eli Lilly, ticker LLY, has almost doubled since the March hype cycle began. Data out in August by Novo Nordisk showed Wegovy not only helped people lose weight, but also reduced the risk of heart attack and strokes by 20%. Now, shares of the medical device makers were already under pressure on earlier weight loss results, but this news just had investors rushing for the exits, fearing the worst, that people would no longer need those diabetes devices or the other obesity-related care. Shares of those device makers and other companies have plunged an average 27%, led by a 58% cliff in Insulet as investors rushed out. Overall, the iShares U.S. medical device ETF, the ticker IHI, has dropped 23% from its July peak to the October low, wiping out $1.2 billion in value. And the broader medical device universe of stocks has seen a combined $300 billion lost in market value just this year. But now as reason comes back into the market, these stocks could be great value plays. First, because that recent research results from the weight loss drugs had silver linings for these battered stocks. The Wegovy studies showed a high discontinuation rate for patients. It seems not everyone wants to take a shot every week for the rest of their lives. The drugs also don't work the same for everyone, meaning some people will see relatively little weight loss. That in itself was enough to breathe the life back into some of these beaten down medical device stocks, but there's another bigger picture that could mean they have further to rebound, and that is that there are still hundreds of millions of Americans that are obese and will need diabetes medication, joint replacements, and the gamut of medical devices. The CDC estimates that 40% of adults are obese. That's 80 million Americans, with over 120 million overweight and getting there. Even for those on these miracle weight loss drugs, the damage has been done for a lot of people. You don't get off your diabetes medication overnight, and that strained heart ain't getting any better. Abbott Labs, ticker ABT, is the largest of the 5 stocks and still down 9% on the year after an 8% rally last month. Of the largest medical device makers, Abbott has taken it the hardest with its focus on cardiovascular and diabetes solutions. Devices are 33% of its total revenue, most of that from cardiovascular, and much of the 38% from its diagnostics business is tied to that heart health and obesity related as well. And devices are the company's second fastest growing segment, with sales up almost 15% in the third quarter. But the fear is that a healthier America on those GLP-1 meds might not have as many heart problems. In its most recent reports, management is making it a point to highlight that patients on these weight loss drugs, those GLP-1 medications, are still using the monitoring devices, but the question is, for how long will they need to? We'll look at the valuation measures on all the stocks here. Here in the statistics tab on Yahoo Finance, we see that shares here of Abbott are still a good deal though at a price of about 23 times this full year expected revenue of $4.44 a share. Now that is the expected revenue over the next year. The 35 times PE ratio you see here is trailing, so the price divided by the earnings over the last year, and the shares normally trade around 29 times earnings, so there is some value here for a low double-digit growth stock that pays a 2% dividend yield. Next, shares of Dexcom, ticker DXCM, are up 52% since I highlighted them in that video mid-October, and are back to where they started the year. Expanding waistlines in America has always meant strong growth for diabetes medications and monitoring, and 2023 growth is expected to top 24% for this company to $3.6 billion in revenue, with a solid 19% operating margin as the company rides that diabetes epidemic to what it believes could be 783 million patients by 2045. We are already spending nearly $1 trillion annually for diabetes medications and monitoring. That's a big part of the reason why I think the device makers aren't taking a sustained hit from these weight loss drugs. Even as patient volume grows on these GLP-1s, it's going to be a long time before it dents that spending on diabetes solutions. And Dexcom here is uniquely positioned in monitoring with both hardware and software for diabetics, with apps for connectivity with their family and healthcare providers. I think that gives us a competitive advantage against some of the other device makers and monitorers in the space. Of course, management is on the ball here and has also worked to show that these GLP-1 initiation results will not destroy demand for their patients, tracking users over 5 years and showing the two can work together effectively. But now, as we look at the valuations, the worry for Dexcom here, as it will be for Insulet next, is that growth and the stock's valuation tied to that growth. On 24% sales growth this year and expectations for 20% next, the shares trade as a growth stock and depend on that revenue and the earnings to continue that growth. Even on full-year expected earnings of $1.43 a share, the shares still trade at 79 times on a price-to-earnings basis and 12 times its revenue. Now that's well below the historical average you see here, making it appear to be a good value. But if there is any sign that revenue growth is slowing from these miracle weight loss drugs, then that price is going to come crashing down on lower valuation multiples. And we're going to see that same situation in shares of Insulet Corporation here, ticker PODD. It's up 40% since that October video, but still down 36% for the year. Like Dexcom, this one is focused on diabetic management through its Omnipod device, though I don't think it has quite the breadth of products or software and connectivity that we saw with Dexcom. Insulet is quite a bit smaller here at just $13 billion of market cap versus DXCM's $48 billion company size, and it's clear investors are more worried about Insulet. Revenue was up 27% year over year in the third quarter, continuing that ramp up in growth from 23% last year. The operating margin of 13% here is good, not as good as Dexcom though. Insulet is just expanding internationally, which could be a growth driver in the future, but right now it's mostly focused to US with that 35% growth from the last year. On that valuation side, we do see that same growth stock price here with Insulet. With 26% revenue growth this year and 20% expected next year, shares are trading for 97 times its full year expected earnings of $1.92 per share. Now, because of the valuation and its competitive advantage in hardware and software, I think I prefer Dexcom here to Insulet, but both are going to do well if that GLP-1 drug fails to dent that diabetes market. I'm going to highlight those next two medical device stocks next, two of my favorites, but while you're investing in these individual stocks, take some stress out of the market with these index funds as well for a kind of a set it and forget it strategy of investing. Check out the video here for the 5 index funds you can buy and never have to worry about. Size does count for a $105 billion Medtronic, ticker MDT, now even for the year after a 15% rebound since October, but this one never really sold off entirely like the others. Even though it's slightly smaller, Medtronic is more diversified than Abbott, with only 44% of its revenue from diabetes and cardiovascular devices. It's also got a stronger pipeline of product approvals, with 130 device approvals across its geographies. Now, growth in these big $100 billion device makers is quite a bit slower, with revenue up 5% overall. That's about 5% growth in cardiovascular, 4% in neuroscience, 6% in med surgery, and then 7% growth in that diabetes segment. So while diabetes is the fastest growing segment here, it still has that strong growth in neuroscience and surgery that won't be affected by the GLP-1s. But then that slower growth does mean you get the shares at a lower multiple than these smaller device maker companies. The stock is priced at 15 times full year expected earnings of $5.16 per share. And One thing I do want to point out here is you always need to double check these numbers on Yahoo. It says here the price to earnings ratio is 25 times, but on reported earnings of $5.30 over the last 12 months, so trailing earnings of $5.30, it's actually 14.8 times PE. So always double check these numbers you see here on the statistics page. Boston Scientific, ticker BSX, never really saw a GLP-1 related sell-off, and the shares are now up 19% for the year. The $81 billion device maker doesn't have any diabetes exposure, but cardiovascular devices are 47% of revenue, which goes to show you where the real fear here is in these weight loss drugs. It is in that diabetes segment of the market that smaller waistlines will mean fewer with the disease. More than 1.4 million people are diagnosed each year, and the vast majority of these are those obesity-related type 2 diabetes. BSX is still posting solid growth though, expecting revenue higher by 11% this year, 9% next to $15 billion in sales. Here again though, you're paying for it with a price that is 27 times its full year earnings of $2 per share. Look for that link below, click through and get your customized investing plan, an investing plan right for your goals. Or click on the video to the right for the 5 index funds you can add to your portfolio for set it and forget it investing. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.